Okay, thank you again for joining us. We're going to go ahead and get started on today's webinar, again titled Accounting and Tax Updates for the Mortgage Industry. I am just going to go through a few housekeeping items here. Today, all participants are placed on mute, so if you do have a question, there is a question function on your dashboard. If you want to go ahead and type that in, we will do our best to address those questions at the end. We do have a lot of information to cover, so if we do not get time at the end to answer your questions, we will be sure to follow up with you directly and get those questions answered. Also, a recording of today's webinar and the slide deck will be emailed to all participants, so do look for that in your email box in the next day or two. For those of you who are seeking CPE credit today, please note that you must answer all 3 poll questions during the presentation in order to qualify. You do not need to answer the questions correctly, but please do submit an answer so that we can ensure that you qualify for the credit. CPE certificates will be available to those who qualify and sent via email, so please look for those in your inbox in the next few days as well. A survey will also appear on your screen following today's presentation. We do encourage you to fill that out whether you are seeking CPE or not. We value the feedback that you give us on how we can make these webinars as valuable to you as possible, and it does help us in planning for future webinars as well. With that, let me introduce today's presenters. We have 2 of our senior managers here in our mortgage banking practice. Gina West is a senior tax manager on our team, and Ann Matsumoto is a senior audit manager on our team. Both presenters today specialize in serving our clients in the mortgage banking industry. So with that, I'm going to go ahead and turn it over to Gina, and she's going to get started with her presentation.
All right, good afternoon. So we'll sort of go over a few highlights of what we're going to cover today, and then we'll get into some of the details, respectively, for myself and Ann. So some of the tax updates. The first one we're going to cover is really the hot topic I think everyone's curious about. It's just discussing some of the qualified business income proposed regulations. We'll touch on also some updates that occurred recently for the interest deduction limitation, some proposed regs there, some updates to meals and entertainment that were recently issued, and just a few other tax notes. So for the accounting updates, we'll go over some impacts to IMBs for the coming year, some accounting standard updates, as well as some other things just high level to keep in mind. So, of course, the high profile topic of qualified business income, I think is really relevant, especially in the lending industry. But for those of you that haven't maybe attended some of our prior webinars, I'll give you a brief overview of what the qualified business income concepts are and what the deduction calculation looks like. So for tax years beginning after 2017, there is a new Section 199A code section that was established to add details around the qualified business income concept. And under this section, basically non-corporate taxpayers, individuals especially, who have QBI or qualified business income from a pass-through entity or also sole proprietors, they're allowed to deduct 20% of QBI earned from a trade or business. So one thing to note, this is sometimes a common partner or shareholder in a pass-through entity is grantor type trust, and they actually will fall outside of the 199A trust rule. So just a note for your preparers, if you're having these discussions, that's a unique qualification there. Now, the 20% deduction is really something new all in of itself. So it's not a deduction to reach adjusted gross income or AGI, and it's not an itemized deduction. It's really something that, as we know taxable income today, it will reduce taxable income. So again, we're definitely going to see changes in forms for especially 1040 filers. So just keep that in mind. And then as well, to sort of define what qualified business income is, it is generally ordinary income effectively connected with the conduct of a trade or business. within the U.S. And it really doesn't include those sort of investment or portfolio related items. So things like interest income, dividends, investment interest expense, capital gains. It also does not include guaranteed payments from partnerships. So to break it down, basically the general deduction, while subject to limits, which we really aren't going to go into today, just note that they're out there. The deduction itself is really the lesser of the combined qualified business income of the taxpayer, or 20% of the taxpayer's taxable income reduced by the sum of net capital gains. And the unique aspect here is that this deduction really is specific to those qualifying trades or businesses. So again, you'll see the specified service trader business sort of phrasing come about in the next couple slides, but assuming the taxpayer is not a specified service trader business, then this is what the deduction would look like. So also to note, which we're not going to go through specifics on calculations or anything like that, the deduction would be further limited by a wage limitation as well as an asset test. So for partnerships or S corporations, basically the compensation deduction or the W-2 wage deduction that occurs at the entity level will effectively pass through to the shareholders or partners so that they'll be able to use those wage computations in evaluating their eligibility for the qualified business income deduction. So they'll basically get an allocable share of that amount from the entity level. Now it will increase their own W-2 wages from a taxable income perspective. It's really just an allocation for them to use in computing the QBI deduction. So this is the significant challenge to the availability of the deduction, this concept of the specified service trader business. So to sort of better define it here for you, the specified service trader business really limits the availability of the deduction, and if the certain dollar amounts here, $315 for married filing joint and $157.5 for single, plus some phase-in amounts. If their qualifying income is less than these amounts, then they'll still be eligible for the QBI deduction. But essentially, if they're a specified service trader business and their income exceeds these amounts, then their eligibility for the deduction is really not allowed at that point. So to sort of define what a specified service trader business is, we have sort of three concepts here that are listed. I think the last one is really the most pertinent, but we'll get to that and we'll touch on it in a little bit more detail as well. So a specified service trader business is any trader business involving the performance of services in quite a few different fields here. I think the most relevant maybe is the financial services, accounting, as well as brokerage services areas. There's a few others there that probably don't apply too much to lenders. It can also be any trader business where the principal asset of such trader business is the reputation or skill of one or more of its employees. And then lastly, it can also be any trader business involved in the performance of services consisting of investing and investment management, trading or dealing in securities, and this is where we sort of get kind of hung up from a tax perspective for lenders, and we'll touch on that. But it also would not include, or the specified service definition does include partnership interests or commodities. So just keep that in mind, that the dealing in securities language is really where we see the biggest impact to lenders. So the biggest news in regards to the QBI deduction were the proposed regulations issued on August 18th. And I'm sure you've all heard quite a bit about it. We've tried to communicate quite a few things in regards to actions that are being taken, but basically these proposed regulations set forth some specific computational structures for computing the deduction, as well is defining the qualified businesses, so enhancing that specified service trade or business sort of definition. So with that being said, there was language that specifically excludes lenders in certain areas in the proposed regulation, such areas as consulting, financial services and trading, as well as reputation or skills. But unfortunately, the current definition of the SSTB in the proposed regs includes taxpayers, again, that engage in dealing in securities. And so we'll get into a little bit more of that detail here. So what that means to you all in attendance here is that basically an SSTB dealing in securities would include mortgage banking companies that either sell more than 60 debt instruments or debt instruments that represent more than 5% of the tax basis of their debt instruments acquired during the year, regardless of how they're acquired. So again, that's sort of the OMSR versus the PMSR concept. And so you can see that this definition is definitely problematic, and that it appears to pull in lenders into the SSTB definition, and it really significantly impacts lender owners' ability to take the QBI deduction. So effectively, what would be a 29.6%, effective tax rate, you're now looking at 37%, which is the highest rate without the QBI deduction. So, it really begins a lot of discussion around potential filing positions, entity conversion conversations, as well as, estimate calculation approaches. These regs have gone through a public comment period. You may have heard from some of us here at the firm on, hey, reach out, let's issue some comments to really support the concepts that we feel lenders do not or should not, fall into this SSTB definition. And I think there were over 400 comment letters, if I recall correctly. So, they had a really good response rate. Excuse me. And, with that being said, it's hard to say if Treasury will, take those comments and make any potential updates to the regulations based on the feedback. And it's hard to say as far as timelines of when they might actually finalize these regulations. So, in the event that they're finalized without differing language from its current state, that might be more beneficial to lenders specifically, we really are just waiting and kind of hoping to see what they'll come up with. It certainly will make a big impact to many taxpayers, not just lenders, but certainly we are hoping for guidance there. So we'll definitely continue to monitor developments here and definitely provide, sort of side conversations as needed to clients or others that have questions on, considerations for filing options and just what, additional guidance might help us identify in returns and so forth. So, in that regard as well, many clients and taxpayers are considering potentially converting to a C corporation from, say, an S corporation to benefit from the lower tax rate. And so, there'll be further discussions, I'm sure, on, what's the benefit of restructuring, and then as well, if you do determine that that's a desirable outcome, talking as well about some of the inability to reverse those consequences later. So, for example, revoking an S election can basically create a 5-year timeline where you can no longer re-elect that S status until that time period lapses. So we're going to launch our first poll question now, and we'll give you a few seconds to kind of read through that and respond, and then we'll get back to the slide. All right, thanks for responding to that question. So it was, what is the qualified business income deduction percentage? And the correct answer was B, 20%. So I'm sure there'll be probably some follow-up questions that may come up in regards to the 199A concept. So please let us know if there's anything we can, help clarify for you. But in the meantime, we'll move on to the business interest deduction limitation concepts here. So for this new issue, as created by the Tax Cut and Jobs Act, beginning after 2017, all businesses will be allowed a deduction for trade or business interest incurred during the taxable year, to the extent that the total amount of such interest does not exceed the sum of the three items below. So basically, it's a business interest income plus 30% of the business's adjusted taxable income. Those are really going to be the most, I think, applicable to lenders. And just note for item 2 that adjusted taxable income is sort of a concept around EBITDA, so earnings before interest, taxes, depreciation, and amortization. And so this is really calculated without regard to items that are not properly allocable to a trade or business, also without regard to business interest or business interest income, as I said, depreciation and amortization, as well as net operating losses and the qualified business income deduction. So this limitation applies to all entity types, including C corporations, flow-through entities, as well as proprietors that do not meet the small business exception that we'll define a little bit later. And it also would impact those who are eligible to opt out but choose not to. And lastly, I would say here to note that, and this is kind of unique to the calculation, but specifically for pass-through entities, this limit is calculated at the pass-through entity level, and then as well, again, at the individual level. So again, the idea here is business interest, and so portfolio interest income and investment interest expense of individuals is not considered to be trade or business interest for the purposes of these rules. So to clarify sort of the accepted businesses concept here for who is pulled into this limitation, there's a gross receipts test that determines sort of if you're a small business and then qualify for an exemption from this limitation. And if your average annual gross receipts for the 3 taxable year period ending with your prior taxable year, if those do not exceed 25 million, then the limitation actually would not apply here. So, I guess from a lender perspective, it really depends on your size. If you're, sort of in startup phase, that might actually be more applicable to you. As well as, down the line, it's possible that your gross receipts actually exceed that limitation. And so then you have to kind of run through the analysis. But we're sort of seeing overall in the industry that, if you're not extremely highly leveraged, and you're really just sort of recognizing that first interest payment on the first borrower's payment, and then you have your warehouse line debt interest expense, for the most part, in general, I would say, we're not seeing too much of a limitation there, but it also will be impacted by that second item on the prior slide that touches on the adjusted taxable income concepts. So that item actually cannot be less than 0. So if you're in a loss position, it's important to really run through the calculations and see what that might look like. So the second accepted business is the selecting trade or business exemption, where certain industries have the ability to opt out of the limitation rules. And these include real property trade or businesses, as well as farming, agricultural, or horticultural businesses. And if you're electing out, businesses will be required to apply separate depreciation rules, and it's just a unique component to allowing you to bypass the interest limitation. They're sort of also creating some depreciation components that'll go with that. So any deduction for business interest that's taken into account in determining the pass-through entity's non-separately stated taxable income is really going to impact your ordinary income or loss bucket, sort of if you think of Schedule K or what that looks like on your tax return. So if a partnership is a partner in another partnership, then the limitation is determined without regard to the distributive share of income or loss from that lower tier. And really, this is just intended to prevent double counting. We'll touch on a few additional rules in regards to that concept shortly. But without such a rule, the same dollars of adjusted taxable income of a partnership could potentially generate additional interest deductions as that income is passed through to its partner. So it's important to be aware that, you know, as you have maybe tiered structures, that you'll really have sort of a dynamic calculation to work through. But any amount of this portion that's potentially disallowed is carried forward indefinitely. So it's not a permanent difference, it's just a timing difference. Not always a great answer, I guess, either way, but at least you don't lose the deduction completely. So in the case of a C corporation, this disallowed portion effectively is carried forward similar to an NOL, and then it could be subject to certain limitations if corporate acquisitions occur, which we can touch on actually on a later slide as well for some C corporation updates. And then from a partner's perspective, it's kind of unique, but a partner's adjusted basis and its partnership interest is impacted by its pass-through income on Schedule K that it receives on its K1. And so effectively, this interest or adjusted basis is reduced by the amount of the excess business interest allocated to the partner, even though the carry forward does not give rise to the partner deduction in the year of the basis reduction. So if you have that carry forward, you're actually going to reduce basis in that year, and then in a subsequent year, if you actually are then allowed the deduction later, your basis is not reduced by it because you've already taken that sort of in year one. So just keep that in mind. It's sort of a different application to the basis concept there. So some additional considerations for flow-through entities that really touch on the idea of that double counting rule that we mentioned on the previous slide is, so first double counting, and then kind of on the flip side, you have the excess taxable income rule. So basically, in determining the limitation at the partner or shareholder level, the calculation should generally exclude distributive share of income from the entity already utilized, kind of like we mentioned already, and this avoids income from being used twice in calculating the limitation. And then on the flip side, if you're determining that limitation at the partner shareholder level, the calculation can include income from an entity if no limitation occurred at that entity level and there's an excess taxable income amount available. So they're basically allowing you to take a larger interest expense amount by being able to utilize that excess income in this calculation at the next tier. So it's sort of the opposite of the double counting rule there. So in regards to this new limitation, there were proposed regulations issued. These were pretty recent on November 26th. They're very lengthy. They have different criteria for C corporations, different criteria for pass-through entities, and some clarification for individuals as well. So they're very detailed and lay out a pretty lengthy process. But some of the content that is included in the proposed regulations discusses more details around the accepted trades or businesses, so rules and procedures for making those elections to be an electing real property trade or business and an election to be the electing firm business. And the proposed regulations also establishes rules for determining the amount of taxpayers' interest expense, interest income, and other items properly allocable to an accepted and non-accepted trade or business. So you can sort of have multiple activities potentially in any given entity. It also touched on some consolidated rules. So a consolidated group is effectively treated as a single corporation. And really the distinction between the accepted and non-accepted trades or businesses here applies at the level of the trade or business, not at the level of the group member. So really just keep that in mind. It occurs without regard to which member conducts the trade or business or possesses those assets used in the trade or business. The regs also touch on allocation of asset basis, and it establishes, again, rules around, structuring that between the accepted and the non-accepted trades or business. And just note here that it is subject to various rules in sort of structuring basis. So some of the C Corporation specific rules were also clarified. It touches on basically that all business interest income and business interest expense in a C Corporation structure are included in this calculation. And basically, as you work through the analysis, although C corporations cannot have investment interest, investment expense, or investment income within the meaning of this other code section 163D, for the purposes of this limitation in 163J, a partnership in which a C corporation is a partner may actually have such sort of investment items. So just be mindful of that as well. And if you're a C corporation, just know that you have some unique rules to consider there. Lastly, for the C corporation rules, it touches also on some of the interaction between other code sections in regards to the interest limitation. So Section 382, which as a C corp you hear a lot about if you have net operating losses, and Section 381, which really refers to corporate acquisitions. So there's some interplay there. It would also include under 382 those thoroughly separate return limitation year calculations as well. We'll kind of move on to meals and entertainment. I know this is often sort of a complicated area for any company, but especially lenders. But with the Tax Cut and Jobs Act, they effectively made entertainment expenses completely non-deductible. So they've disallowed a deduction for expenses with respect to entertainment, amusement, or recreation. And basically, this new notice that was issued back in October really just provides some transitional guidance in regards to these changes. So the Tax Cut and Jobs Act does not specifically address the deductibility of expenses for business meals. And so, kind of keep in mind that you might have heard in the past, if you're trying to identify what is a business meal or business entertainment, you had sort of this directly related to or associated with test that you would review to establish the potential deductibility of it. But with the Tax Cut and Jobs Act, these tests have been repealed. So that's why they've issued this notice as sort of temporary guidance or interim guidance. Something to just keep in mind too is that the concepts around the expense being ordinary and necessary, as well as not lavish or extravagant, are still really important to being able to sort of qualify a deduction as business or for business. So this notice has really set forth sort of 5 criteria that really clarify when a taxpayer can deduct 50% of an otherwise allowable business meal. So while the entertainment component has been converted to non-deductible, business meals have still remained at 50% eligible for deduction. There's a few specifics that might fall into being fully deductible. We won't touch on that today, but just know in general, business meals are 50% limited at the entity level. So to go through sort of the 5 things that really establish the allowable deduction, again, the expense should be ordinary and necessary. It should, again, not be lavish or extravagant. Typically, you would also want an employee or the taxpayer or an officer of some sort to be present at the actual occurring food or beverage activity. And then as well, you would really want that food and beverage provided effectively to a current or potential business customer, client, consultant, or similar business contact. You know, things like vendors. You all deal with, I think, a lot of different types of customers, internal and external. So just keep that in mind as well. But this last one is really the one I think that's most relevant to lenders especially. But this one is basically if, in the case of food and beverages provided during or at an entertainment activity, the food and beverages are purchased separately from the entertainment, or the cost of the food and beverage is sort of separately stated from the cost of the entertainment. Whether that's on an invoice or some sort of subsequent supplemental detail from the vendor, you really want to sort of encourage that difference of reporting so that you can maximize your deduction potentially at the entity level. And just know that they have specified that in this area, the entertainment disallowance rule may not be circumvented through trying to push more of the cost towards the meals portion versus the entertainment portion of the activity. So just be careful and mindful of that as you go through, you know, understanding your potential deduction there. You know, I think as it relates to lenders, you know, consider that your loan officers are often hosting, you know, entertainment for that sort of potential relationship building. They might be hosting, you know, golf outings or events at sporting activity, concerts, or, I mean, really various types of activities. So, you know, I think this concept of identifying the costs on the invoice will be really important. I think you'll want to understand, even on your general ledger, the breakout between the two components now, whereas in the past you may have had one account that was sort of meals and entertainment combined. You'll definitely want to bifurcate that now in your ledger so that you have meals separated from the entertainment component so that you can, again, maximize the deduction of the meals as they're eligible. And we'll launch our second CP question here and allow you some seconds to respond. Right. So for that question, it was generally what percentage of business meals are deductible, and the correct answer was B, 50%. So to kind of wrap up the tax section of today's webinar, we just wanted to mention a few other highlights that have kind of come about recently. One being in regards to what they're calling the applicable financial statement conformity rule under section 451B, which basically is a discussion of any item of gross income that is effectively reported on your financial statements, or in this case, lenders file, you know, audited financials. And so you would all qualify in that regard, but they've allowed sort of some automatic consent procedures recently on if you're impacted by that new tax law. There's some rules in place around how you can go about implementing that new method. But just keep in mind that in regards to the derivative, you know, really, if tax realization hasn't occurred at that point for recognition, then the rule really doesn't require income recognition under this AFS rule. So for example, if a taxpayer is currently reversing the derivative pursuant to, again, interpretation of 475, then that income or loss is really treated as unrealized, and it can remain that way if that's your current method. So just keep that in mind. Typically, as well with you know, yearly tax updates, there's usually a tax extenders bill that'll kind of walk through. There's like 20 to 30 different things that expire sometimes in any given year, and sometimes they're addressed before the end of the year. Sometimes they're sort of after year end. If, for example, the 2017 extenders didn't actually pass until February of 2018, and they were passed retroactively. So certainly makes a couple things hard to plan for, but just keep an eye out that, you know, there may be some extenders coming. Some of the items that typically get addressed in the extenders bill include items like the exclusion from gross income for the discharge of qualified principal residence indebtedness, also the deductibility of mortgage insurance premiums treated as qualified residence interest, deduction for qualified tuition and related expenses, and definitely many tax credits and energy provisions. So those will be some things that you might see coming down the pipeline there from the IRS and from Congress for that matter. And then lastly, we would expect with the Tax Cuts and Jobs Act that they pass a technical corrections bill and potentially some additional tax reform items, but it's hard to say what that'll look like. But right now, it's sort of currently in progress. We're really thinking that right now the bill probably will need to be passed in the new Congress next year, as the prospects for passage of a current bill being discussed in the House is really not likely to be passed this year. So again, we'll sort of see what the coming months bring with regards to the QBI deduction and the specified service trade or business definition, as well as some extenders and some technical corrections that are needed for the actual Tax Cuts and Jobs Act. So with that, I will pass this on to Anne to take us away.
Thanks, Gina. Hello, good afternoon, everyone. So this part of the webinar will be going over some of the relevant accounting updates that will impact you guys, including, revenue recognition, the new lease guidance, the CECL model, which I'm sure most of you are familiar with, as well as some other relevant updates that will impact you guys. So to start with, let's jump into the highly anticipated revenue recognition guidance for Accounting Standards Update 2014-09, Revenue from Contracts with Customers. Now, this is going to apply to any entity that either enters into contracts with customers to transfer goods or services or for the transfer of non-financial assets. The core principle behind this guidance is that an entity should recognize revenue for that transfer of goods or services to customers in an amount that reflects the actual consideration to which the entity expects to be entitled to in exchange for those goods or services. Now, it's a 5-step process that they've provided for us as a guideline in recognizing your revenue. The first step you'll want to do is identify the contracts with a customer. You'll then want to identify the performance obligations that you have in your contract. Calculate and figure the transaction price for your contract and allocate that transaction price to your performance obligations in the contract, whether it's single or multiple performance obligations that might be outlined. And then the last step you'll want to do is to recognize the revenue when or as the entity satisfies the actual performance obligation or obligations. Now let's jump into the first step, identify the contract. Now when identifying the contract, the parties must have approved the contract. They must be able to identify each party's rights as well as the payment terms as it relates to the actual goods or services being transferred. The contract must have commercial substance. And in addition, it must be probable that the entity will collect the consideration to which it will be entitled. Now, if this isn't met, the entity will recognize the revenue in the amount of the actual consideration received when the entity has transferred that control of those goods or services. Once the control has been transferred, that is now when the other party will assume control and rights to those amounts that they're purchasing. Now, in your performance obligations, as mentioned before, you can either have single performance obligations or multiple. Single is pretty straightforward. If an entity promises to transfer only one good or service to the customer, then you just have your single performance obligation. For multiple, this will be if you have more than one good or service that's promised, you'll want to account for each promised good as a separate performance obligation only if one of the following two items are met. If the obligation is distinct That is, if both of these criteria are met, that the customer can benefit from the good or service and it is distinct within the context of the contract, or if you have a series of distinct goods or services that are substantially the same and have the same pattern of transfer, you'll want to consider those multiple performance obligations and measure them separately. Now, in determining your transaction price, there's a few different things you'll want to consider. You'll want to consider the effects of any variable consideration. If there's the existence of any significant financing components that you may have in your contracts, as well as any non-cash considerations and considerations that will be payable to the customer. So let's dive into the variable considerations. With this, you could have variable components that can be estimated using either the probability weighted approach, which is the expected value that you expect to receive, or an approach based on a single most likely amount. Whichever you choose, it needs to be the more predictive method. And in addition, no adjustment to the transaction price should be made for the doubt about collectibility. If an entity has any doubts over collectibility, you should be considering this in the impairment of the receivable and not in the recognition of the actual revenue. Now, jumping into if the contract has any significant financing components, you'll want to look at the cash selling price. So an entity should recognize revenue at an amount that reflects the price that a customer would have paid for those goods or services if the customer had paid cash for those goods or services. So when you're considering this financing component, you'll want to consider the combined effect of not only the expected length of time between when the entity transfers the promised goods or services and when the customer actually pays for the goods or services. Now, if there's, if it's a lengthy period of time that extends well beyond a year, that's definitely something that you guys will want to factor and consider into the price, as well as the prevailing interest rates that might be prevalent in the market. Now, if you have any non-cash consideration, these should be measured at fair value at contract inception. And any consideration payable that you may have to a customer, this will want to be considered as well in your contract and could include things such as, a credit, such as coupons, vouchers, anything that can be applied against amounts that are owed. Also, with regards to sales tax, entities can make an accounting policy election to exclude those sales tax amounts that are collected from the customers from the transaction price. Now, when you're allocating the transaction price, you'll want to consider the standalone selling price. So you'll determine that standalone selling price at the contract inception for each performance obligation. So this is something you definitely will want to consider if you have multiple performance obligations that need to be met. Now, if this standalone selling price is not observable, your next best bet is going to be to estimate it. And below that are some estimation methods that you guys can consider, such as the cost plus margin, adjusted market assessment, as well as the residual value. The last step in the recognition of revenue guidance is that revenue should be recognized as performance obligations are satisfied by transferring those actual goods or services to the customer. Now, as mentioned before, that transfer occurs when the customer obtains the actual control of the asset. And this refers to the customer's actual ability to direct the use of and obtain substantially all of the remaining benefits from the asset, in addition to the customer's ability to prevent other entities from directing the use of and obtaining the benefits from that asset. Performance obligations can be considered to be transferred over time or at one certain point in time. If performance obligations are transferred over time, you'll want to consider the following criteria to ensure that one of the following is met. Either the customer simultaneously receives and consumes the benefits provided by the entity's performance as those obligations are performed, or the entity's performance creates or enhances that asset that the customer controls. The entity's performance does not create an asset with an alternative use to the entity, and the entity has the enforceable right to payment for the performance completed to date. When you're recognizing this revenue for performance obligations that are transferred over time, you'll want to recognize it by measuring it with the progress toward complete satisfaction of that performance obligation. And this is similar to what some of you guys may be familiar with, which is the percentage of completion. Now, for certain performance obligations that will be satisfied at a point in time, there's indicators that will provide you guys to alert you that control has been transferred, whether it's the entity has a present right to payment for that asset, the customer has legal title to it, they have the physical possession of it, they've incurred and now have the significant risks and rewards of that ownership of the asset, as well as the fact that they've accepted it. And that leads us into our last CPE poll question. We'll go ahead and give you guys a few seconds to answer that question, and we'll jump back into the rest of the accounting updates. Okay, and the last CPE poll question was, Accounting Standards Update number 2014-09 requires which contract characteristic in order to be considered a contract within the scope of this update? And the correct answer was D, that the contract must have commercial substance. Okay, let's jump into equity investments now. So I'm sure most of you are familiar with the distinction between trading and available for sale securities and how those realized gains or unrealized gains are run through your income statement, whether it's through your earnings or through your OCI. And so with the exception of equity investments qualifying for the equity method, or in circumstances where the investee is required to prepare consolidated financial statements, all investments in equity securities are now required to be reported at fair value with unrealized gains and losses reported in the income statement. So now you will no longer see gains and losses running through your guys' other comprehensive income. Everything will run through your income statement. For any equity investments that you guys may have without readily determinable fair values, you may elect to measure such security at cost less impairment. Now, this will require an adjustment, either plus or minus, resulting from observable price changes in orderly transactions for an identical or similar investment of the same issuer. And for debt securities, unlike the changes that we've seen to equity securities, any investments in debt securities will continue to be classified in the three categories listed below, which you guys should be more than familiar with: trading, available for sale, and held to maturity. Okay, here's another hot topic, the new lease accounting guidance. So I know that this may kind of throw a wrench in some of your guys' processes and all of that. So it will be important that you prepare in advance, making sure that you've got the right lease software in place that you can track and, calculate these changes. So let's dive in. Your lessee accounting. So for any lessees, you'll want to recognize on your balance sheet the present value of any unpaid lease payments as a lease liability, and you'll also want to have a right of use asset representing your right to use that underlying asset for that lease term. Now, when you guys are measuring these assets and liabilities, you'll want to exclude optional period payments such as lease extensions, unless it's reasonably certain and probable that the option to extend will be exercised. So what you guys will see on your balance sheet, lessees will record a right-of-use asset. You'll also have the corresponding lease liabilities for all leases with terms greater than 1 year. Lessors, on the offhand, will record PP&E for operating leases and a lease receivable for any sales type or direct financing leases. The initial balance sheet amounts are the same for both operating and financing, but because the depreciation pattern may differ, depending on the lease classification, your balance sheet amounts may vary in future years, so keep an eye out for that. And any new right-of-use assets will be subject to impairment testing, so you guys will need to develop a process for evaluating those write-downs and assessing whether an impairment needs to be booked. For your guys' operating leases, you will have a recognition of the asset and liability as mentioned before on your balance sheet, initially measured at the present value of those future lease payments. That recognition will be calculated so that that cost is allocated ratably over your lease term, so on a straight line basis. And the classification of your guys' cash payments on your statement of cash flows will be within your operating activities now. For your financing leases or our capital leases, the recognition of the asset and liability will be on your balance sheet, initially measured at the present value of your future lease payments. You'll have your interest expense on the lease liability that'll be recognized separately from the amortization of the asset. So you will want to record those two amounts in two different GL accounts. You'll have your repayments for the principal portion of any lease liabilities classified as financing outflows on your statement of cash flows, while the payments of interest will be classified as operating outflows. Now, the impact to business that you guys will see or may experience is that this could merit reassessing your lease buy decisions as you guys go through and consider your warehouse lines and your debt covenant compliance. In addition, most outstanding leases will now have to be recorded on your guys' balance sheet. So as mentioned before, you guys will need to develop new processes and systems to account for these current and future agreements. For a lot of you, you've got a lot of branches, you guys are incurring a lot of lease agreements, so this can be a very robust and time-consuming process. So it is important to pre-plan for this. The new assets also recognized for operating leases will change the company's book-to-tax difference computations. So that's important to keep an eye out. It could also affect your guys' state and local tax apportionment. Now, I know we're running out of time, so we'll briefly run through some of these last items. Most of you guys are probably familiar with these. You've got the CECL model for your current expected credit losses. The accounts that it will most likely and commonly affect on your guys' balance sheet will be your mortgage loans held for investment. The current methodology allows that companies can delay the recognition of credit losses until a qualified event occurs and the loss becomes probable. But now under CECL, the entire life of the loan's losses must now be taken into consideration, regardless if a qualifying event occurs. It must be both probable and reasonably estimated. The provision under CECL must be recorded immediately based on the life of the loan concept, and it must be reported at the net amount expected to be collected. Your estimable forecast will be allowances based on a variety of methodologies, either on an individual or a collective pool basis that we've listed below. Now, you guys will be getting the slide decks, so you can go back and reference these items after the webinar. Your stock compensation for Accounting Standards Update 2017-9, in general, you've got your modifications for the share-based payment awards that will be recorded, that you will record the incremental value arising from any changes as an additional compensation cost. This modification accounting will be required only if the fair value, vesting conditions, or the classification of the actual award as equity or liability, and the changes as a result of the change in terms or conditions. some of you guys have goodwill. So with regards to intangibles and your goodwill, it will remove step 2 of the goodwill impairment test. That step 2 requires that a hypothetical purchase price allocation be determined to calculate the implied fair value. A goodwill impairment will now be the amount by which the reporting entity's carrying value exceeds its fair value. So it should simplify this a little bit. And that leads us to the conclusion of our webinar. I hope you guys learned a lot. If you have any questions, please feel free to reach out to us and we will get back to you directly.
Again, yes, thank you for attending today. Certainly thank you to Gina and Ann for presenting. There was a wealth of information here. Again, we will be sending out the slide deck and a recording of this webinar so you can go back and reference all of this great information. Just a reminder, we did get a good number of submitted questions, but unfortunately we are really out of time to address those. I will pass those along to Gina and Nan, and they can follow up with you directly to make sure that your questions get answered today or very shortly. And again, finally, there will be a survey that appears once we close out the webinar today. We do really ask you to fill that out. It does help us plan for future webinars. So with that, we want to thank you for your time. Appreciate you joining us for this hour, and happy holidays to everyone. Thank you.